Think accounting is just for math wizards? Think again. Hey there, I used to think the same thing. Accounting seemed like this mysterious world of complicated formulas and endless calculations that only people with finance degrees could understand. But here's the thing, accounting is actually just organized common sense. It's basically keeping track of what you own, what you owe, and whether you're making or losing money. That's it. Today we're going to break down the fundamentals so you can actually understand what's going on when people start throwing around terms like assets and liabilities. No complicated math, no confused jargon, just the basics that actually make sense. What is accounting really? So let's start with the most basic question. What exactly is accounting? At its core, accounting is just a system for recording and communicating financial information. Think of it like keeping a detailed dollar diary of money, where it comes from, where it goes, and what's left over. The American Institute of CPAs defines accounting as the art of recording, classifying, and summarizing in significant manner and in terms of money transactions and events. Sounds fancy, but really is it? It's just organized record keeping. That's it. Now, why does this matter? Well, every business from the corner coffee shop to massive corporations like Apple needs to know three basic things. What do they own? What do they owe? And are they making money or losing it? This isn't some modern invention either. Archaeological evidence shows that people were keeping accounting records over 7,000 years ago in ancient Mesopotamia. They were literally keeping track of grain and livestock on clay tablets. The double entry bookkeeping system we use today, formalized by an Italian mathematician named Luca Pacioli in 1494. So, yeah, this stuff has been around for a while. By the way, if you want more in-depth technical education to be fully blown by the experts that are experts in this field on this topic, check out my link tree in the description below. You won't regret it. Now, here's where it gets interesting. All of accounting, and I mean all of it, boils down to one simple question. Ready for this? Assets equals liability plus equity. That's it. Every single business transaction, every financial statement, everything in accounting comes back to this equation. Let me break this down in plain English. Assets are simply things that business owns that have value. This could be cash in the bank, inventory on the shelves, equipment, buildings, even the things like patents or trademarks. Liabilities are what the business owes to others. Think loans from the bank, money owed to suppliers, unpaid bills, basically any debt. Equity is what left over for the owners after you subtract all the debts. It's like the net worth of the business. Here's a simple way to think about it. Imagine you buy a house for $300,000. You put down $60,000 and take out a mortgage for $240,000. In accounting terms, the house is your asset, $300,000. The mortgage is your liability, $240,000, and your equity is $60,000. Assets, $300,000. Liabilities, $240,000. Equity, $60,000. The equation always balances. This concept was really solidified by Pacioli, I mentioned earlier. It's been the foundation of accounting ever since. Now that we understand the basic equation, let's talk about how business actually communicate their financial information. There are several financial statements, but two main ones you need to know about. The balance sheet. First up is the basic balance sheet. This is basically a snapshot of the business at a specific point in time. It shows exactly what the company assets, what it owes, liabilities, and what's left for the owner's equity on a particular date. Think of it like talking to a photo of your financial institution. And if someone asks you right now, what do you own and what do you owe? Your answer would be your personal balance sheet. The balance sheet gets its name because it must always balance. Remember our equation? Assets always equal liabilities plus equity. If it doesn't balance, something's wrong with the numbers. Now, the second one is the income statement. The second key statement is the income statement, sometimes called the profit and loss statement, or P&L. While the balance sheet is like a snapshot, the income statement is like a movie. It shows what happened over a period of time. The income statement tells you whether the business made money or lost money during a specific period, like a month, quarter, or year. It starts with revenue, money coming in, subtracts expenses, money going out, and shows you the profit or loss. The basic structure is pretty simple. Revenue minus expenses equals net income. If it's positive, the business made money. If it's negative, it lost money. These two statements work together. The profit or loss from the income statement flows into the equity section of the balance sheet. It's all connected. In, Interestingly, the standardization of this financial statement really took after the stock market crash in 1929. The Securities and Exchange Commission, established in 1934, started requiring public companies to provide standardized financial information to investors. Now, here is something that trips up a lot of people. Revenue and cash are not the same thing. This is probably one of the most important concepts to understand. Let's say you run a small consulting business. You complete a project for a client and send them an invoice for $5,000. In accounting terms, you've earned $5,000 in revenue in the moment you complete the work, even if the client hasn't paid you yet. But your bank account, still the same as before. You won't see that cash until the client actually pays the invoice. This is called accrual accounting. It's the standard way most businesses keep their books. Revenue is recognized when it's earned, not when cash changes hands. Expenses are recognized when they are incurred, not when they're paid. The alternative is cash accounting, where you only record transactions when money actually moves. This is simpler and what many small businesses use, but it doesn't give you a clear picture of your business performance. This distinction was really formalized by accounting standard boards. The Financial Accounting Standard Board, or FASB, which sets accounting standards in the US, has specific rules about the when revenue can be recognized. These are called revenue recognition principles. Why does this matter? Well, a business could show a profit of its income statement, but still run out of cash if customers are slow to pay. This is why successful business owners pay attention to both profitability and cash flow. All right, let's tackle the part that scares most people: debits and credits. I promise this isn't complicated as it sounds. First, forget everything you think about what these words mean. In accounting, debit doesn't mean bad, and credit doesn't mean good. They're just directions. Think of them as left and right. Every transaction in accounting affects at least two accounts, and the total debits must always equal the total credits. This is double entry bookkeeping system from Pacioli I mentioned earlier. Here's the basic rule. Assets and expenses increase with debits. Liabilities, equity, and revenue increases with credits. Let's walk through a simple example. Say a business buys $1,000 worth of inventory and pays cash. What happens? Inventory, an asset, goes up by $1,000. That's a debit. Cash, also an asset, goes down by $1,000. That's a credit. Total debits $1,000, total credits $1,000. They balance. Or let's say the business makes a sale for $500 cash. What happens? Cash, an asset, goes up by $500. That's a debit. Sales revenue goes up by $500. That's a credit. Again, debits equal credits. The reason the system works so well is that it creates a built-in error checking mechanism. If your debits don't equal your credits, you know you made a mistake somewhere. This might seem backwards at first, especially when you think about your bank statement where deposits and the credits and withdrawals are debits. But remember, your bank statement is from bank's perspective, not yours. To the bank, your account is their liability. They owe you that money. Now, why should you care about any of this? Even if you're not planning to become an accountant, understanding these basics can really help you in everyday life. If you're thinking about starting a business, you'll need to understand financial statements to know whether you're succeeding. If you're investing in stocks, you want to read company financial statements to make informed decisions. Even if you're just managing your personal finances, these concepts can help you think more clearly about your financial situation. According to a study by the National Financial Educators Council, the average American loses about $1,230 per year due to financial illiteracy. Understanding basic accounting concepts is a big part of financial literacy. Plus, if you ever find yourself in a conversation where people are talking about business finances, you'll actually understand what they're saying instead of nodding along and hoping nobody asks you a direct question. The beauty of accounting is that once you understand those fundamentals, everything else builds on them logically. More complex topics like description, depreciation, inventory valuation, or financial ratios all use the same basic principles. If you want to dive deeper, there are plenty of resources available. The American Institute of CPAs has great educational materials. The link below in my description also has very accessible prices to all the necessary materials to get you straight from zero to a hero. But honestly, just understanding what you have covered today puts you ahead of most people. You now know what the assets, liabilities, and equity are. You understand that the basic financial statements. You know the difference between the revenue and cash, and you have a basic grasp of how debits and credits work. So there you have it, accounting basics explained. Simple, see? No mass wizardry required, just logical organized thinking about money and business transactions. Next time someone starts talking about balance sheets or profit margins, you'll know exactly what they mean. And who knows, maybe you'll be the one explaining it to someone else who thinks accounting is just for mass wizards. Remember, accounting is just organized common sense. Once you see it that way, it all starts to make perfect sense. Thanks for sticking with me through this video. Now you've got all the necessary information for your business and everyday life finances. But it was pretty cool, right? Leave me a like, subscribe, and see you in the future. Cheers.